Today, in a mirror, dimly. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today I want to update you with some of the latest news around the traps, and this report is brought to you thanks to Ribbon Property Consultants. The latest auction clearance rates from SQM Research, which by the way I regard as the most accurate in the industry, to the 6th of June 21, does make interesting reading. Not only are they consistently lower than those reported in the mainstream media, with Sydney at 62% compared with Domain's 77%, and Melbourne's SQM reading at 36.1 compared with Domain's 62.5%. But there is a rise in sales made before the auction. Edwin Almeida and I discussed this in our recent rant, making the point that more vendors seem willing to agree a sale prior to auction than a few weeks back. Now, this might be because offers are now higher, or it may be that vendors are being more realistic about getting a sale, but it will be interesting to see how these trends develop in the weeks ahead. Our research is suggesting that there will be more listings coming on in the spring, and that of course could change the dynamics again, but Domain went full spruik on the weekend results, starting with an uninhabitable home in Sydney's southeastern suburbs with no kitchen, toilet or power connected, sold under the hammer this week for a massive $4.705 million. The home at 25 Duke Street, Kensington, also had no water connected, selling agent Andrew Farrer's Joe Recep said, but didn't put buyers off. The roof wasn't leaking after the recent rain we had, so it was still solid, he said. 4 bidders registered for the auction, with 2 wanting to restore the original period home while the others were looking to tear down and rebuild on the 556 square metre block. The vendors, who had owned the property since 2005 when they paid $1.1 million, had planned to restore it before changing their minds, Mr. Recep said. It sat empty for some years as agents received hundreds of calls from buyers wanting to snap up the home even before it was listed for sale. The winning bidder at the weekend will now be looking to rebuild on the block. The sale was one of the biggest at the weekend, with Sydney's preliminary clearance rate sitting at 77%. After 1,048 auctions were scheduled and 770 results reported. There were 97 properties withdrawn from auction that were cleared as not being sold as part of the clearance rate. The results followed one of the strongest months of clearance rates in Sydney, Domain senior research analyst Nicola Powell said. For houses and units, this month's clearance rate is the strongest May result in 6 years, with 78.2% of reported house auctions finding a buyer and 75% of unit auctions securing a sale, Dr. Powell said. The difference between house and unit clearance rates does appear to be narrowing, and it's likely to be associated with increased investor and first home buyer participation or overall affordability bottlenecks for those trying to purchase a house in Sydney. There were still plenty of home buyers out and about at the weekend, with 4 families registering to bid at an auction in Sydney's northeast, where the home sold for more than $1 million over the reserve price. The 3-bedroom home at 21 Battle Boulevard, Seaforth, had an opening bid right on the reserve of $4.5 million before competition saw it sell for more than $1 million above the reserve. It had similar interest to the home in Kensington, with 2 buyers looking to tear down and rebuild the original home, while 2 others wanted to renovate it. Ray White Seaforth principal agent Mark Griffith said the buyer will be looking to knock down and rebuild the home, which he estimated would cost another $5.5 million. A home across the road sold recently for just under $12 million, so it's definitely in that price range, he said. The buyer saw it on day one and was pretty committed to buying it. The ecstatic vendors, who had owned the home for 7 years, were downsizing, moving closer to their family in the lower North Shore. One of the oldest homes on the lower North Shore, or at least in Waverton, also sold at the weekend for $1.775 million. That's $25,000 above the reserve to local first home buyers. The home, known as Blacksmith's Cottage at 34 Iroka Street, was built in 1865 with Australian writer Henry Lawson living next door, according to the vendors Natalie and Cameron Gentle. The couple now live in Coffs Harbour and sold the home, which they had kept as an investment for the past few years. Henry Lawson used to live next door, and when the old blokes down the road were young boys, he'd pay them sixpence to drag him home from the pub in their billy cart, Mr. Gentle said. He was a frequent visitor to most of the houses in the street, and the Blacksmith's Cottage was no exception. The couple bought the property in 2005 for $600,000, and Bell Property Camere selling agent Tom Scabagiano said a mix of first home buyers, investors and downsizers registered to bid. The charm, character and history of the old Blacksmith Cottage were big draw cards for the 4 registered bidders, ensuring a strong outcome for the vendors. Waverton remains a highly sought after suburb for buyers from all areas of Sydney, he said. On the upper North Shore, 12 bidders, all young families, registered for a chance to buy a 4-bedroom home that sold under the hammer for $2.62 million, well above the $2.2 million reserve. Not surprisingly, the home at 30 Barunga Avenue, West Pymble, sold to a young family moving into the area from the Blue Mountains. Selling agent Alex Mintorn said the buyers had first made an offer on the house when it was off market for $2.2 million, but upped their offer during the auction. They made just 2 bids to buy the home. The vendors, meanwhile, were selling up and moving to Melbourne to be closer to family, Mr. Mintorn said. Now, I also note that this whole piece also appeared in the AFR, just helping to reinforce the spruik, which of course all related to top-end property, where most of the action is. I'd also highlight the fact that down the property value sets, the outcomes are rather different. Now, if you're buying your home in Sydney's contentious markets, you do not have to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high. Price discovery and price transparency are hard to find. Then there is the wasted time and financial investment that you make. Now, Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email on info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can receive a 10% discount. Now, the mortgage battle continues to rage with more increases. Westpac has become the first of the big banks to make a move on their 2-year fixed interest rate, raising them from 1.79% to 1.89%. Their 3-year rate has also gone up by 10 points, from 1.88% to 1.98%. Westpac's 2 main subsidiaries, St George Bank and Bank of Melbourne, will also move their rates in line with that of their parent company. CBA was the first to move on 4-year and 3-year rates, but Westpac have jumped the gun in advance of expected rises in the price of money that will follow the beginning of the new term funding period at the end of June. Even with this new rate, though, Westpac is still below the symbolic 2% threshold of ultra-low rates. ANZ are still the only one of the big 4 banks above that marker, although they're currently offering 2.04% across 1, 2 and 3-year fixed home loans for owner-occupiers. The interest price war has been going on since at least March, if not earlier, as all the major lenders sought to take advantage of the current low price of money, as seen with the current 0.1% cash rate, to offer increasingly low rates for mortgages. And of course, the Reserve Bank, through the Term Funding Facility, has been throwing very cheap money at the banks. That ends in June. That has in turn sparked the ongoing property boom, as a diverse range of circumstances have come together to see exploding house prices in both metropolitan areas and regional Australia. The low interest rates, the lack of spending in 2020 caused by COVID-19, and the rebounding confidence in the economy are just some of the factors which have led to the property boom that's called by some a perfect storm. Of course, the Reserve Bank of Australia insists that it will not budge on the historically low cash rate until wage growth is sufficiently high and unemployment is sufficiently low, which they say will not be before 2024, but expect more out-of-cycle moves, and I think that probably those cheapest rates have gone forever. APRA recorded close to $130 billion in new residential mortgage loans during the March quarter, around a third more than the year before, according to the latest APRA quarterly authorised deposit-taking institution property exposure data. And it showed that a rise in owner-occupied loans has driven an increase in residential mortgage lending. New residential lending during the March quarter totalled $127.2 billion. That was slipping by 0.8% from the prior quarter, but it had surged by 34.4% from March the year before. APRA reported that lending to owner-occupiers had grown more rapidly than lending to investors over the year, with a growth of 37.7% and 29.7% respectively. The result is consistent with favourable borrowing conditions, including a historically low interest rate environment and government measures supporting first home buyers and new home building, APRA said. There was $88.9 billion in new owner-occupied loans during the March quarter. The segment only slightly increased market share during the 3 months, up by 0.1% to 69.9%, but the segment has climbed 1.5% higher than March 2020. Investor loans remain unchanged from the quarter before, occupying 28.6% of the market, with its quarterly total of $36.3 billion in new loans. However, but that was higher than last year, when investor loans were just 29.7% of all loans. Third-party originated loans also grew over 12 months at $68.8 billion in new loans over the quarter, and that's now 54% of the market, compared with 51.1% in March 2020. Our surveys show that many people are using third-party advisors, mortgage brokers in particular, to help find the best deals, particularly with the moving rates that are currently in play. The share of new higher-risk loans, such as lending at high loan-to-value ratios, declined over the quarter, but the share of new lending at high debt-to-income ratios increased. That's reflecting partly first-time buyers, but also looser lending standards. For loans with LVRs greater than 80%, the share of new lending fell to 41.1% from 42% in the previous quarter, and newer lending at lower loan-to-value ratios remained high, with more than half, 58.8% actually, of all new loans funded at LVRs less than 80% in the March quarter. The share of new lending at higher LVRs also remains below levels seen over the past decade, APRA said. And turning to net profits from the ADIs, profits climbed steadily during the quarter, up 3.8% for the year, to a collective $29.4 billion. The sector's profit had spurted from the prior quarter by 34%. But of course, a lot of that is because the higher levels of write-offs and provisions that were made were reversed in the quarter. Credit outstanding for residential mortgages totaled $1.9 trillion at March. That's 1.2% up on the prior quarter and 3.6% higher than the year before. Owner-occupied loans covered 64.6% of the total credit outstanding at $1.2 trillion, increasing the share over the year by 1.9%, while investor loans shrunk by 1.6% to 32.9%, or $625.1 billion. Interest-only loans shrunk by 3.5% year-on-year to 13.9%, and that's about $246.1 billion in March, while loans with a LVR equal to or higher than 90% was 4.7% of the market, or $89.3 billion. The overall LVR profile of ADI's housing loans remains strong, with most outstanding residential mortgages well covered by collateral, APRA said. And finally, there's more on the inflation debate with this from Deutsche Bank. They argue that this time is different for inflation and policymakers could be facing their most challenging time in more than 40 years. This is from their new report called What's in the Tails? Inflation, the defining macro story of this decade. The bank's senior economists note the globally receding fear of inflation and rising levels of government debt that shaped a generation of policymakers. And they started with some quotes which I think are worth repeating. Back in 1978, Ronald Reagan said, "Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. In 2021, Joe Biden said a job is about a lot more than a paycheck. It's about dignity, it's about respect, it's about being able to look your kid in the eye and say everything will be okay. Too many people today can't do that, and it's got to change. In 2021, Janet Yellen said, "Neither the president-elect nor I proposed this relief package without an appreciation for the country's debt burden. But right now, with interest rates at historic lows, the smartest thing we can do is to act big." And Jerome Powell in 2021 said, "During this time of reopening, we're likely to see some upward pressure on prices, but these pressures are likely to be temporary as they are associated with the reopening process." And finally, Larry Summers in 2021 said, "I think this is the least responsible macroeconomic policies we've had in the last 40 years." Economic policy should now prioritise broader social goals. Their report debates whether inflation is transitory or the pursuit of these important social priorities by governments, and whether it will mean inflation will have longer-term and far-reaching implications for the health of the global economy. Either way, they say, higher inflation is coming and policymakers are about to face their toughest battle in 40 years. They say that two of the biggest historic constraints on macroeconomic policy, inflation and debt sustainability, are increasingly perceived as not binding. In turn, the removal of these constraints has opened the door for new goals for macro policy, which go far beyond simply stabilising output across the business cycle. This changing approach to macro policy has been formalised in the Federal Reserve's operating procedures, making a broader interpretation of its mandate possible. Unlike in previous eras, when it was common practice to preempt inflation overshoots with higher rates, today's Fed has said they want to see actual progress, not just forecast progress. The new average inflation targeting approach only increases tolerance for inflation. Where the US leads, others tend to follow, they say. Even in Germany, with its reliable fiscal discipline, there is growing support to reform the constitutional debt brake in order to permit more deficit spending. Although in aggregate the EU's fiscal stimulus has been more limited than that in the US, the arrival of the €750 billion recovery fund financed by collective borrowing potentially opens the way for further such packages in response to future crises. It's hard to see the ECB stepping back from helping to finance such fiscal investments in the continent or moves to promote further integration. In short, we're witnessing the most important shift in global macro policy since the Reagan-Volcker axis 40 years ago. Fiscal injections are now off the charts at the same time as the Fed's modus operandi has shifted to tolerate higher inflation. Never before have we seen such coordinated expansionary fiscal and monetary policy. This will continue as output moves above potential. This is why this time is different for inflation, they said. And the Deutsche economists say that even if some of the transitory inflation ebbs away, we believe price growth will regain significant momentum as the economy overheats in 2022. Yet we worry that in its new inflation averaging framework, the Fed will be too slow to dampen the rising inflation pressures effectively, and the consequence of delay will be greater disruption of economic and financial activity than would be otherwise the case when the Fed does act finally. In turn, this could create a significant recession and set off a chain of financial distress around the world, particularly in emerging markets. History is not on the side of the Fed, they say. In recent memory, the central bank has not succeeded in achieving a soft landing when implementing a monetary tightening, when inflation has been above 4%. And the economists say few people still remember how our societies and economies were threatened by high inflation 50 years ago. They say the most basic laws of economics, the ones that have stood the test of time over a millennium, have not been suspended. An explosive growth in debt financed largely by central banks is likely to lead to higher inflation, they say. We worry that the painful lessons of an inflationary past are being ignored by central bankers, either because they really believe that this time is different, or they have bought into a new paradigm that low interest rates are here to stay, or they are protecting their institutions by not trying to hold back a political steamroller. Whatever the reason, they said, we expect inflationary pressures to re-emerge as the Fed continues with its policy of patience and its stated belief that current pressures are largely transitory. It may take a year longer, perhaps until 2023, but inflation, they say, will re-emerge. And while it's admirable that this patience is due to the fact that the Fed's priorities are shifting towards social goals, neglecting inflation leaves global economies sitting on a time bomb. It is a scary thought that just as inflation is being deprioritized, fiscal and monetary policy is being coordinated in ways the world has never seen. Recent stimulus has been extraordinary, and economic forecasting, which is difficult at the best of times, is becoming harder by the day. Fractured politics amplifies the problem. Needless to say, the range of global outcomes over the coming year are wide. When central banks are eventually forced to act on inflation, they will find themselves in a difficult, if not untenable position. They will be fighting the increasingly ingrained perception that high levels of debt and higher inflation are a small price to pay for achieving progressive political, economic and social goals. It will make it politically difficult for societies to accept higher unemployment in the interest of fighting inflation. Eventually, though, any social priorities that policymakers have will be set aside if inflation returns in earnest. Rising prices will touch everyone. The effects could be devastating, particularly for the most vulnerable in society. Sadly, when central banks do act at this stage, they will be forced into abrupt policy changes which will only make it harder for policymakers to achieve the social goals that our societies need. Low, stable inflation and historically low interest rates have been the glue that have held together macro policy for the last 3 decades. If, as we expect, this starts to unravel over the next year or so, then policymakers will face the most challenging years since the Volcker-Reagan period in the 1980s, according to their report. And I have to say, I think they're onto something here, although I am not as convinced as they are that there is structural inflation coming. But nevertheless, there is a risk of policy misstep from central banks, and then the need to adjust quickly. And if they do have to take that route, that could be extremely disruptive. Now, I discussed all of this the other day on a show on DFA with Damien Klassen from Nucleus Wealth and What the World Fund. And it's worth just going over those 2 shows where we went into detail around some of the underlying factors relating to inflation. But whatever you think, the question of inflation and deflation and how it plays out is probably one of the most fundamental questions that we need to get our head around, because it really will change everything. It changes the amount of money in the system, it changes how that money is deployed, and it changes the impact on real people. And if it is true that inflation is going to bite, and bite hard in the next 1 to 2 years, and interest rates need to rise, that could be particularly devastating. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.